Okay, let's unpack this. I want you to imagine, just for a second, that you've taken delivery of this state-of-the-art Formula One racing engine,
Okay.
right? So it's this absolute marvel of modern engineering, born from, I don't know, billions of dollars in research, and it's capable of generating this mind-bending, just unadulterated speed. But then you go to install this absolute beast into a chassis, and you realize the only thing you have to use for a fuel line is a standard, plastic garden hose that you just picked up at the local hardware store.
Yeah, the visual of a high-performance engine just completely choking on a restricted intake, it perfectly maps to the crisis happening inside the world's most advanced data centers right now.
Right.
Sitting here looking out over the sprawling Texas industrial landscape where the hum of these massive data facilities and almost blends in with the glowing server racks right here in this room, you realize we are dealing with a severe physical bottleneck.
Yeah.
We have unbelievable processing power that is being actively starved by its own infrastructure.
And that infrastructure bottleneck is the entire mission of today's deep dives. We are sorting through this massive stack of financial reports, SEC filings, and totally conflicting market predictions,
Yeah.
all focused on a single company.
Applied Optoelectronics or AAOI?
Exactly, AAOI. We need to figure out if this company's massive, bet the farm corporate pivot is going to make it the ultimate infrastructure investment of this decade, or if it's just an enormous, highly volatile delusion trap.
Yeah, and it's a critical question because when we talk about the AI boom, everyone fixates on the brains of the operation.
Right, the GPUs.
Exactly. We endlessly analyze the NVIDIA GPUs that cost, 30 grand a pop, but almost nobody is talking about the garden hose. They ignore the massive data traffic jam happening in the physical space between those chips.
So what is that traffic jam? Because I know the industry has a specific term for it.
Yeah, they refer to this as the AI bandwidth wall. And what's fascinating here is that we have to understand this isn't a software glitch.
Yeah.
It is not a bug in the code that engineers can just patch with a quick firmware update. We are running into a fundamental hard limitation of physics.
Wow, okay.
Inside these server racks, data is moving at speeds that essentially test the boundaries of traditional materials. We are looking at a standard pushing toward 1.6 terabits per second.
1.6 terabits.
Yeah.
Okay, so we all know, generally speaking, fiber optics are faster than copper.
Right.
But it helps to understand why a data center can't just keep beefing up traditional cables.
Right.
Like a 1.6 terabits per second, old school copper wiring literally physically cannot handle the job. The electrical resistance generates immense amounts of thermal noise.
Huge amounts of heat, yeah.
And the environment gets so hot and the electrical signal physically degrades so quickly that the data packet just dies out after a few feet. Like the garden hose bursts, basically.
It does. You see that physical limit manifest when the data simply fails to reach the next server rack intact. So to keep those F1 engines fed, data centers are forced to abandon sending data as electricity through copper wire for any significant distance. They have to transition to sending data as pulses of light through fiber optics.
Light.
Yeah, light. And to do that, they require specialized hardware called optical transceivers. The transceiver's job is to sit at the edge of the server, take a massive incoming electrical signal, instantly convert it into light, shoot it across a fiber optic cable, and then convert it back into electricity on the other side.
With like near zero latency.
It's exactly near zero latency.
Which brings applied optoelectronics into the center of the frame. Because their corporate story is just fascinating to me. Just a few years ago, AAOI was primarily known as a supplier for the cable TV industry.
Yeah, broadband amplifiers, mostly.
Right. They built broadband amplifiers.
Yeah.
Which is a completely respectable, steady business, but frankly, it's a sleepy one. But then they orchestrate one of the most dramatic pivots in recent corporate history. They bet the entire future of the firm on building these ultra-high-speed AI optical transceivers for the biggest tech companies on the planet.
And the raw numbers from their filings suggest that pivot is working, at least on paper.
Okay, let's look at those numbers.
Yeah, so looking at their Q1 2026 earnings, their data center revenue didn't just grow, it exploded by 154% year over year.
154%.
Overall, Q1 revenue hit $151.1 million, and then Q2 jumped again, hitting $192 million.
Okay, but I have to push back on the core premise here just a little bit.
Sure.
If I am a hyperscaler, right, a massive tech giant like a Microsoft or an Amazon, and I am building a multi-billion-dollar AI supercomputer, why would I trust the nervous system of that machine to a pivoting cable TV supplier?
It's a fair question.
Because established, deeply capitalized giants like Cisco or Coherent, They already exist in this space. They've been doing this.
Well, the filings point to two major competitive moats that answer that exact question. The first one is their manufacturing model. AAOI operates with really depth vertical integration. They don't just buy discrete parts from third-party vendors and snap them together on an assembly line.
Oh, so they're not just assembling things.
No, they fabricate their own core components from scratch. Most notably, the microscopic indium phosphide laser chips that sit at the absolute heart of the transceiver.
Okay, wait, the technical filings mention a fabrication method they use. It's called the molecular beam epitaxy process, or MBE.
Right, MBE.
What does that actually mean in practice?
So MBE is essentially 3D printing, but at the atomic level.
At the atomic level. Are you serious?
I am. Imagine a highly controlled vacuum chamber where you spray a mist of individual atoms, allowing them to settle into a flawless crystalline structure layer by microscopic layer.
Oh, wow.
That is how AAOI builds these lasers. And by controlling the process at the atomic level, they produce chips with virtually zero microscopic defects.
Which is critical when you're moving that fast.
Exactly. When you are pushing light at terabit speeds, even a nanometer of thermal expansion or a tiny structural flaw will misalign the laser and completely destroy the data packet. So having vertical control over that MBE process gives them a massive advantage in yield control and quality assurance.
So it secures their supply chain from the inside out. They own the recipe.
Exactly.
But their second moat isn't actually about the laser technology at all, right? It's strictly about geography.
Yes, geography is huge right now.
We can kind of look at this as the American moat, because where you physically build your hardware matters immensely for these hyperscalers right now.
It really does. If we connect this to the bigger picture, the geopolitical landscape is forcing hyperscalers to drastically de-risk their infrastructure supply chains. Over-reliance on manufacturing in Taiwan or broader Asia presents a serious structural vulnerability for U.S.-based tech giants.
Right, they need it closer to home.
They need localized domestic production capacity to ensure uninterrupted expansion of their data centers. And AAOI recognized this logistical demand. So in April 2026, they were awarded a $20.9 million grant from the Texas Semiconductor Innovation Fund.
Oh, okay.
Yeah, they are utilizing those funds to rapidly expand a 210,000 square foot advanced manufacturing facility right in Sugar Land, Texas.
So they are dropping the production right into the backyard of the U.S. tech ecosystem. And the scale they are aiming for, I mean, it's staggering. The reports indicate they're targeting a production rate of 650,000 of these advanced units per month by the end of 2026.
Right. And reaching that run rate would give AAOI the single largest AI transceiver production capacity located within the United States.
Wow.
And that highly secure localized capacity is a primary reason they secured a massive $324 million advanced node backlog.
And a big chunk of that is from one customer, right?
Yes. The anchor of that backlog is a single order worth over $200 million for their next generation 1.6 terabit transceivers coming directly from a major hyperscaler.
Okay, so let's summarize where we are. On paper, the pivot looks like an absolute masterclass in corporate strategy. They have the F1 fuel line that the industry desperately needs. They have the atomic-level manufacturing control. They have the secure U.S. factory, and they have a 9-figure order from a tech giant.
It sounds perfect.
But here's where we hit the turbulence.
Yeah.
Because when you actually analyze the cash flow statement to see how they're financing this hyper-growth, the financial reality becomes incredibly harsh.
Hardware manufacturing is notoriously unforgiving, and AOI is currently navigating what the industry calls the Valley of Death.
The Valley of Death. That does not sound good.
It's the brutal life cycle phase where a company must spend hundreds of millions of dollars, pouring concrete, buying clean room equipment, hiring specialized engineers, long before a single finished product rolls off the line and actually generates cash.
Okay, so it's like a small independent restaurant that suddenly goes globally viral on social media.
Yeah.
Like the line is wrapping around the block. Demand is completely off the charts.
Yeah.
But the owner is so desperate to buy enough premium ingredients in commercial ovens to feed everyone in line, they literally have to start selling off the bricks of the actual restaurant building just to raise the capital to stay open.
That is a very accurate way to frame it. The financial mechanisms mirror that dynamic really closely.
How bad is the cash burn?
Well, looking at the first half of 2026, AAOI's cash flow statement reveals an investing cash outflow of $633 million.
$633 million. just gone.
That is capital flying out the door, almost exclusively allocated for facility expansion and manufacturing equipment.
Yeah.
And covering a $633 million shortfall requires some very aggressive maneuvers.
Right, and they went straight to the financial markets to cover it. Because the filings show they brought in $980 million in financing inflows in the first half of the year.
Yeah.
And they accomplished this primarily by issuing over $1 billion in new equity. I mean, they are heavily watering down the soup for existing shareholders. They even announced a $600 million at the market, or ATM program.
Right, the ATM program.
And for anyone unfamiliar, an ATM program basically allows a company to just continuously sell newly created shares directly into the open market whenever they need a quick cash injection. And unsurprisingly, the market punished them for it.
Severely.
The stock slid 9.6% on the day that program was announced just due to massive dilution fears.
Because the mathematical reality for shareholders is incredibly stark. The outstanding share count has ballooned from roughly 50 million shares in Q1 2025 to over 81 million shares by Q2 2026.
So you're just getting cut into smaller and smaller slices.
Exactly. Retail investors are watching their proportional ownership of the company shrink quarter by quarter as the business absorbs these massive fixed costs.
But let's look at the actual earnings for a second, because I saw the headlines highlighting their non-GAAP profit turning positive in Q2. I mean, if they had record revenue of $119 million, shouldn't the economies of scale start kicking in?
You would think so, but the profit narrative requires a really deep audit of their accounting methodology.
Okay.
Because while top-line revenue hit a record scaling up ultra-high-speed hardware manufacturing does not instantly translate to bottom-line profit. Their GAAP gross margin, the strict accounting measure of profitability, it actually fell to 27.7%, which represents a six-quarter low.
Okay, wait, I want to break that down. Why does the profit margin shrink when the sheer volume of products being sold is going up? That seems counterintuitive.
The primary culprit here is yield lag. Installing brand new, highly sensitive manufacturing equipment for 800G or 1.6T transceivers, it isn't plug and play.
Right, it's atomic level printing.
Exactly. The calibration process is painstakingly slow. Once a machine is installed, it must undergo intensive multi-month cleanroom audits from the cloud engineers who are purchasing the product.
So the buyers actually come in and audit the machines.
They do. They test for thermal stability, signal integrity defect rates. And during this onboarding phase, manufacturing errors are naturally higher, which ruins the yield. So the massive capital expenditures are front-loaded onto the balance sheet immediately. But the manufacturing efficiency required to actually turn a profit takes several quarters to catch up.
Which brings us back to how they claimed a profit turnaround in the press releases.
Yes. Companies heavily leverage non-GAAP metrics, adjusting their official numbers to exclude specific costs they deem one-time or non-operational.
So what did AAOI exclude?
Well, in Q2, a massive portion of AAOI's non-GAAP profit turnaround was artificially padded by a $14.26 million tax adjustment.
$14 million just in a tax adjustment. Wow.
Yeah. So to see the actual operational health of the factory floor, we have to look at adjusted EBITDA, which measures core operating cash flow. And their adjusted EBITDA remained negative at $543,000.
So they're still bleeding cash.
The Texas expansion is burning cash faster than the transceivers can replenish it.
Okay, so what does this all mean? We are looking at a scenario with massive top-line growth, fueled entirely by massive shareholder dilution. And that naturally pulls us toward the red flags buried in these filings, starting with the human element.
This is a critical piece.
Because while retail investors are being asked to fund this billion-dollar pivot, the internal executives, the people with the deepest visibility into the actual factory timelines, they have been aggressively taking money off the table.
Yeah.
Over the last 6 months, insiders executed 26 separate stock sales.
26 sales.
And the number of open market purchases they made in that same window. 0. Absolutely 0. Executives like Elizabeth Laboa, David Kuo, and Joshua Arrow have collectively sold millions of dollars worth of stock. And obviously executives sell for various personal reasons, right? From tax obligations to, buying a house.
Sure.
But 26 sales to 0 buys is a heavily skewed ratio when you are actively asking the public to bankroll a massive capital expansion.
Yeah, the market often interprets sustained, unreciprocated insider selling as a signal regarding liquidity preferences. Executives holding the deepest knowledge of the yield lag and the true timeline for factory profitability, they are choosing to secure cash now rather than holding their equity through the valley of death.
Right, they're hedging their bets.
Exactly. But analyzing the balance sheet reveals an even larger structural red flag concerning where their money actually comes from: extreme customer concentration.
Okay, this detail completely reframes the whole AI narrative for me. Because when we conceptualize an industry-wide AI supercycle, we tend to imagine thousands of distinct tech companies rushing to buy this hardware.
Right, a huge diverse market.
Yeah, but AAOI's top 10 buyers account for 98% of their total revenue. And even more precarious, just their top 3 customers made up 93% of their revenue in the first half of 2026.
93%. The architectural fragility of that revenue model, it really cannot be
It's
overstated.
terrifying.
If just one of those three hyperscalers encounters a delay in zoning permits for a new data center or decides to switch to a competitor's transceiver for their next server architecture, AAOI's quarterly revenue doesn't merely experience a dip, it faces a catastrophic collapse. The company is hyper-leveraged on the procurement cycles of just three corporations.
And the revenue model gets even murkier when we introduce the Digicom subplot.
Oh, yes.
We discussed their legacy business earlier, making broadband amplifiers for cable TV. Well, recently they won a contract to upgrade 1 million homes for Mediacom. And a major player in this space is a customer called Digicom, who purchases these cable TV components from AAOI. Digicom accounted for nearly 43% of AAOI's total revenue in the first half of the year.
So a massive chunk.
Almost half of this company's top-line revenue isn't even derived from the AI boom at all. But the critical detail, the real red flag, is in the receivables. Digicom represents 67.2% of AAOI's accounts receivable.
That's a huge disparity.
Wait, so is this massive Texas AI factory expansion actually partially being bankrolled by a cable company's IOUs?
That's exactly what's happening. The friction between accrual accounting and cash flow explains that exact dynamic.
Okay, walk me through that.
So accounts receivable means the revenue has been officially recognized on the spreadsheet, right? But the hard cash has not yet hit AAOI's bank account. To secure the cable business, AAOI granted Digicom extended payment terms, allowing them time to build out their broadband networks before settling the invoice.
Okay.
But when a company is burning hundreds of millions of dollars to build an advanced semiconductor factory, a spreadsheet entry does not purchase a cleanroom laser. They need immediate liquidity.
They need the cash right now.
Exactly. That timing difference, booking massive cable TV revenue but having to wait quarters to actually collect the cash, is a primary driver forcing them to continuously dilute the stock to keep the AI factory construction moving.
Wow, so we have this absolutely wild dichotomy. Unprecedented demand and a massive U.S. factory weighed against crushing dilution, insider selling, and essentially cable IOUs. So how is the broader financial ecosystem processing all of this?
Looking at the analyst reports, it is an absolute tug of war.
It really is.
The institutional investors are fundamentally split. Hedge funds like Invesco and BlackRock have massively added to their positions, pouring hundreds of millions of dollars into the stock. Conversely, funds like Hawkridge and Morgan Stanley have been entirely dumping their shares.
And that institutional divide mirrors the deep polarization among Wall Street analysts as well. On the ultra-bullish side, Needham set a street-high price target of $260 a share.
$260.
Yeah, and their thesis rests entirely on the American moat. They argue that controlling localized, highly secure U.S. supply chain dominance for 1.6 terabit transceivers grants AAOI immense long-term pricing power.
So they see that backlog as a lock. Right. They view the $324 million backlog not just as an order, but as verified proof that the hyperscalers have definitively chosen AAOI as their long-term infrastructure partner.
But the bear case is just as aggressive, because Northland Capital Markets set a target of just $57.50.
It's a huge difference.
Massive. And their thesis focuses on the mechanical trap of the financials. They argue the structural dilution will continuously erode shareholder value. If AAOI has to keep issuing millions of new shares just to finish building the factory, the actual earnings per share will remain permanently suppressed, regardless of how high revenue climbs.
Exactly.
Plus, they highlight a massive looming threat that could just strand all of this factory equipment entirely.
Yeah.
Technological obsolescence. Because right now, Pluggable optics, the little magic boxes AAOI builds, those are the gold standard.
Mhm.
But the industry is heavily researching a shift towards something called co-packaged optics, or CPO.
And the mechanics of co-packaged optics represent an existential threat to the current transceiver market.
How so?
Well, with a pluggable optic, the laser sits at the edge of the server rack, meaning the electrical signal still has to travel a short distance across the motherboard before it gets converted into light.
Right.
CPO eliminates that electrical journey entirely. It bakes the laser directly into the silicon of the processing chip itself.
Oh, wow. So it's inside the chip.
Yes. The data is converted to light at the exact moment it leaves the processor. So if hyperscalers successfully commercialize CPO, the entire market for standalone pluggable transceivers could evaporate.
Just disappear entirely.
The ultimate risk in the semiconductor space is the sheer velocity of innovation. By the time a company finishes calibrating a billion-dollar factory for today's physical standard, the hyperscalers may have already engineered a new architecture that renders that standard completely obsolete.
Okay, so for the listener who is watching this stock chart swing wildly by 15 or 20% in a single trading session, trying to decide if this is, the ultimate picks and shovels play of the AI gold rush, what is the synthesizing takeaway from all these filings?
Well, if we connect this to the bigger picture, the macro narrative is undeniable. The physical transition from copper wiring to optical AI infrastructure is a permanent, unstoppable shift.
Right.
The bandwidth wall is a strict law of physics, and fiber optics are the only engineered solution over it. However, identifying a massive technological trend is entirely different from successfully investing in the individual company executing it.
That makes a lot of sense.
Buying into a business undergoing a highly capital-intensive physical expansion requires immense emotional and financial discipline. An investor here isn't just betting on the superiority of molecular beam epitaxy. They are betting on executive management's ability to perfectly thread a highly volatile needle.
Yeah.
They must balance staggering cash burn, slow factory yield improvements, and hyper-concentrated client retention, all while actively diluting the ownership stake of the very investors funding the journey.
It's sort of the stark difference between acknowledging that Formula One is the fastest, most advanced racing series on Earth and betting your entire life savings on a specific team that is actively rebuilding their engine while currently driving 200 miles an hour down the straightaway.
Exactly.
The execution risk is paramount.
It's massive. Which brings us to one final thought to close out this deep dive. We've spent this entire time analyzing how companies like AAOI are fiercely trying to solve the bandwidth wall inside the data center, right? They're turning data into light to eliminate the physical limitations of copper wire, ensuring that distance and thermal heat inside the server racks stop acting as a bottleneck.
Mm-hmm.
But if we pull the lens back and zoom way out, what happens to global geography? If these light-speed optical transceivers eventually become so incredibly advanced that they completely eliminate latency limits across long distances, does the fundamental need for localized massive megacenters disappear entirely?
Right, because if data can travel essentially at the speed of light without signal degradation, could the future of AI computing be completely decentralized? Imagine millions of smaller, highly efficient servers scattered all across the globe, all acting as a single unified supercomputer, instantly connected by the very pulses of light that companies like AAOI are rushing to build today. It forces us to wonder if solving the bottleneck inside the building might eventually make the building itself entirely obsolete, something to think about.